Hello, and welcome to our first Equifax Market Pulse Consumer Insights webinar for 2026. I'm your host for this webinar, Carrie Chung, Head of Insights for Equifax. How's everyone doing? Good to see you all here today. A bit of housekeeping. I believe most of our guests here are quite familiar with the Zoom platform. It is also fantastic to see so many of our audience here are returning to our webinars this year. As for previous times, please feel free to put in the questions throughout the webinar for our speakers. They will be addressed towards the end of the session. To begin, Equifax acknowledges the traditional custodians of the lands across Australia where we gather, work, and collect. Today, I'm on Garramugal land. We recognise the enduring connection to country, waters, and sky. We pay our respect to elders, past and present. We value the rich tapestry of Aboriginal and Torres Strait Islander cultures and their history. We commit to fostering understanding and respect as we journey together towards reconciliation. So to those who have just joined, welcome to our first Equifax Market Pulse Consumer Insights webinar for 2026. Can you believe we're almost in March? Let me quickly introduce myself. I'm Carrie, Head of Insights at Equifax Australia. My team of analysts have worked closely with Stuart and Christopher in preparing the materials you will see shortly. My team focuses on providing actionable insights to help clients and consumers understand the latest trends around the credit landscape. Now, I don't know if he needs any more introductions to this audience. Most of you may have already met Stuart Musgrave as Head of Advisory, who has been with Equifax for close to 20 years. Stuart leads a team of consultants who specializes in credit risk management and effective use of risk analytics. Stuart is an industry expert in consumer credit risk management, credit analytics, and risk management reporting. Stuart played an important role in bringing comprehensive reporting to the Australian market. Let me also introduce Christopher Drotch, who's joined us today. Christopher is the Senior Product Manager for Equifax's Fraud Prevention Solutions and Secretary to Australia's largest private fraud prevention data consortium, the Fraud Focus Group. Chris brings over 10 years of experience in delivering and managing digital platforms across financial services and marketplaces and credit data. He is currently leading the transformation to modern fraud check and developing Equifax's scam prevention solutions. Thank you both for being here today. Now let's begin with the overall credit landscape. Stuart, please take us through what is happening.
Thanks, Carrie, and great to be back for the first webinar of 2026. So looking at the trends that we're seeing in credit demand and other metrics this year at the high level, we are seeing some good growth in credit demand, both in unsecured and secured portfolios. And I'll take you through some of the detail of that by portfolio and the different drivers that are affecting different portfolios at the moment, because there's a few different things happening at the moment. Arrears rates have remained pretty consistent or even reduced a little bit in the last reading. So that is good and really underpinned by the low unemployment that we're continuing to see in the Australian market. We're also seeing some increases in fraud, which is why we've invited Christopher along today. I won't steal his thunder by going through too much of the detail there, but that does form part of our consumer spotlight for today's session. So looking at credit demand in a little more detail, so breaking it down by secured and unsecured. And really the key trend that you can see here is a continuation of what we've seen over the last couple of years. So a couple of years ago, where we saw significant increases in interest rates and inflation, putting a whole lot of pressure on household budgets. That drove a slowdown in consumer credit demand, both for unsecured and secured portfolios. As that pressure eased and interest rates and inflation both came down, we saw consumer credit return to growth. And towards the middle of last year, we had some regulatory changes in the buy now, pay later space, which has certainly driven some increases in unsecured demand through last year. And we've also seen some good growth coming through in the mortgage market. So looking at that by portfolio, and in the secured portfolios, mortgages is where we've seen the majority of that growth. And there's a couple of key drivers that we're seeing behind the growth in mortgage credit demand at the moment. The first is that we've seen a significant uptick in investor demand in market, looking to take advantage perhaps of those increases in rents over the last few years. But also we've seen some changes to the government stimulus packages for first home buyers, in particular the 5% deposit scheme that came in October last year. And that's really helped to drive increases in consumer credit demand during the period as well. So up 12% year on year is quite significant in terms of the trends that we see. On the unsecured side, we've seen some good growth in credit cards. And I'll talk to that in context of cards on issue in market in a moment. But we've seen some consistent growth starting to come through there. It is coming off a lower base after some decreases prior to the pandemic and through the pandemic. But it's been gradually growing back in terms of that credit card demand. Buy now, pay later has really been a bit volatile. There was the regulatory change that occurred in June last year, where buy now, pay later portfolios came into the responsible lending frameworks. So those affordability checks changed the makeup of the products in market between those that contract around each purchase and those that contract around a line of credit where the consumer can make multiple purchases. And we saw a shift across to portfolios where there is a line of credit and the individual can make multiple purchases within that limit. That was a conscious decision on behalf of the government that transition would be a result of the legislative changes that they brought in, and we've certainly seen that occur in market. But what has also occurred as part of that is a number of the buy now, pay laters have used that as a catalyst to really broaden the credit products that they're offering. Many now offering fixed-term personal loans, revolving personal loans, as well as the buy now, pay later products that they have available to broaden the market appeal of their brand and the usability across different consumer use cases. Certainly, a number have increased the credit limits that they're prepared to offer across those product sets. And so that diversification has driven quite an increase in the personal loan line, which you can see at the bottom of the screen there. So personal loans growing by almost 9% year on year as a result of that additional market activity. So we'll continue to monitor how those trends play out going into the future. The economic backdrop sitting behind some of the trends that we're seeing. So as most of you are probably aware, the most recent RBA meeting increased interest rates by 25 basis points. And that was due to increases in inflation that had come through in the CPI numbers. Those higher inflation rates are forecast to continue into the middle of this year before starting to decline through 27 and 28. So we may see some more increases in the cash rate come through from the RBA in the rest of this year. But certainly, if we compare at least where the forecasts are today for both inflation and the RBA cash rate to what we saw a couple of years ago, we're not expecting at this stage to see anywhere near the magnitude of increases in both inflation and interest rates that we saw as part of that cycle. So where the last cycle did drive some decreases in credit demand, we're likely to see, I think, some more moderate influences in some of those credit metrics as a result. Unemployment rate is thankfully remaining at pretty historic low levels, and it's been that way for an extended period of time. May increase by, I think the latest forecast is getting up to 4.6% by mid to late this year, but that's still relatively low in terms of the cycle. And that's certainly helping to underpin low arrears rates for credit products and also low hardship rates that we're seeing in the statistics. And I'll come to some of those details in a minute. But that low unemployment rate is really enabling consumers to be able to maintain their repayments on the whole. Household savings rates, however, are still low. So some of those buffers have been eroded through the increases in inflation and interest rates over the last couple of years. There certainly has been some reduction in those buffers in the market, and that is continuing. So delving into to some of the portfolio trends, and now moving from credit demand into origination, starting with mortgage portfolios. And we've seen that origination growth has been relatively flat in terms of the number of accounts in market. So some of that increase in credit demand may be contributing to refinance activity or churn in the market as people seek better deals, rather than contributing to a lot of top line growth. So you can see that those two lines are coming closer together. So some of those effects in investor loans and first home buyers potentially playing out to move us towards a growth perspective. The trend that is a bit stronger is the trend on amortized limits. So we have seen an increase in amortized limits across the whole portfolio, as well as for those new mortgages being opened. And that I think is a reflection of two things. Firstly, an increase in house prices that we've seen over the last few years, requiring larger mortgages. But also, as interest rates have come down, that enables consumers to be able to service higher loans. And they've been obviously taking advantage of that to be able to get into the property market or to upgrade within the property market. Delinquency rates is painting a pretty good picture. So flat to slightly declining arrears rates showing here. So again, that's a reflection of the easing of the economic pressures and very low unemployment, assisting consumers to be able to service their mortgages. We have seen a slight increase in the proportion of limits on those mortgages. That's, I guess, a reflection of the increase in limits across the portfolio as well. Credit cards is showing a similar picture, so a slight decrease in the number of cards on issue. So that growth that we saw in credit demand predominantly adding into churn in the credit card market as people are potentially seeking better offers, rewards products, low interest products to better suit their needs. Amortized limits looking relatively similar, bit of volatility in terms of the quarter by quarter new accounts being opened. Yeah. Then looking at credit card arrears. Credit card arrears looking very much under control compared to historical outcomes. So sitting around 0.28%, which is flat year on year, and though a slight increase in the limits in arrears, similar to what we saw in the mortgage portfolio. Personal loans is painting a bit of a different picture. So we're seeing some growth in origination in personal loans, and partly that's been driven by that diversification that we're seeing by the buy now, pay later providers, focusing less on the buy now, pay later products and more on the personal loan offerings in market. So driving that personal loan number into almost 3% growth year on year, and a slight growth in the amortized limits across the market as well. Personal loan arrears remaining very much under control as well compared to historical norms, actually slightly down at the 90-day level on a year-on-year basis. Though again, those limits slightly increasing. We do always see a bit of seasonality in terms of particularly personal loan arrears, where we generally see a peak in arrears in Q2, which then declines through Q3 and Q4. So I wouldn't be surprised to see the number tick up slightly as we move into to Q2 this year as well, following that normal seasonal trend. Buy now, pay later, showing some of that growth coming through from the activity that we saw around the regulatory change. Certainly that drove a lot of activity both pre and post the regulatory change in June. And that's influenced the change in the number of accounts in market, and a slight increase in the limits coming through with that as well. Particularly, I guess, as some of those contracting methods are starting to change more towards a line of credit style buy now, pay later product, seeing some increase in those limits. Some increases in arrears in buy now, pay later, though partially that has been driven by a new buy now, pay later provider joining CCR Data Provision, who had a slightly higher risk portfolio than the rest. But the numbers on the right-hand side, as a result, we've looked at Q3 versus Q4, and we haven't seen a significant change in those numbers based on that quarter by quarter difference. Auto loans, starting to see a little bit of easing in terms of arrears in auto loans, though again, that translates to an increase when we look at the value of those loans in arrears. Hardship too is showing quite a good picture. So most of about 55% of the accounts in hardship that we see are in mortgage portfolios. So we do focus quite a bit in looking at hardship trends on the mortgage portfolios. And we saw about a 10% decrease in the hardship in mortgages, which is really good to see, and reflects an easing of those economic conditions that have impacted consumers in the last year or so. Non-mortgage too has also seen some decreases in hardship, and where we have seen some elevated arrears and hardship for mortgages in Victoria, that is starting to normalise. So we did see those increases a year, 18 months ago, developing where Victoria diverged from the national trend. That's starting to normalise a little bit. So at this point, I'll hand back to Carrie for our consumer spotlight session.
Thank you. Thank you, Stuart. If you have any questions for Stuart, please feel free to put them into the Q&A box here, and then we'll get to those towards the end. Stuart's always very popular in that segment. Now, I'm very excited to introduce you to Christopher, Senior Product Manager at Equifax. Before we begin on the fraud insights here, Christopher, can you tell us a little bit about your role across the fraud solution services?
Yes, thank you, Carrie. And thank you for this opportunity to address the audience today. I'm a senior product manager here at Equifax in the identity fraud digital services team. And I look after primarily fraud check and our fraud focus group database, as well as additional fraud prevention solutions. Today, I'd like to talk to you about some of the insights we have from our fraud prevention solutions. And I'd be really looking forward to announcing our second edition of the annual Equifax Australia Fraud Insights. Our mission here is to help Australia's economy respond better to financial crime through sharing data and insights. Before I begin, I'd like to give a bit of background around how these insights are generated. So Equifax facilitates the sharing of attempted application fraud data between over 120 lending members. There is a set of principles that governs how much or how members can search the data and list data. But most importantly, how we identify a suspected fraud, including the type of product that was applied for, details around the type of fraud vector that was used within the fraud attempt, and when the fraud was attempted. So the insights that we are sharing with you today are of robust data quality and consistency. So let's begin and look into some of the insights that we've got. So we go to the next slide. So looking at the volume of listings over the last 12 months, so this data range covers all of 2025, you can see there's a few high-level trends. On the back of strong growth in the past 18 months, we had a record listing year, as well as a peak in Q2 2025, with the annual growth of the year at 4%. That's a 4% rise over 2024 in the amount of listings overall. The economic impact is assessed in terms of value saved. That is, the loss exposure saved if the financial product application had have been granted and a fraud occurred. This is where members contribute this information while listing a fraudulent case. For 2025, this was over 1.5 billion Australian dollars. We then also segment different applications into both credit products, like personal loans, mortgages, auto finance, and credit cards, and non-credit listings like transaction accounts, leasings, insurances, telecommunications, and utility accounts. While overall non-credit listings were slightly down, there's been a significant increase in credit product fraud listings of 11.1%. Additionally, we look at the type of fraud being listed, where in 2025, we observe a stark shift, a move away from identity takeovers and towards first-party fraud, as well as a large increase of money muling activity that Stuart also mentioned at the top of this presentation. So let's dive into some of those trends and move to the next slide. Focusing on the money mule activity, we see there was an increase of over 90% year on year. It's important to define and understand money mules, as I'm sure this audience is not all across that definition. So the AFP define a money mule as an individual recruited, knowingly or unknowingly, to transfer stolen or illicit money through their own bank account, often in exchange for a commission or payment. These individuals help criminal networks launder money by obscuring its legal origins, often via cryptocurrency or rapid transfers throughout the banking system. Our data contribution definitions allow for only the listing of intentional money mules, so such as repeat offenders. Those persons who have been duped unknowingly into being a money mule are not listed throughout the database. Overall, this increase in money mule activity makes this fraud vector account for over 14.6% of all fraud listings. This is a near doubling of their presence across the shared fraud database. This surge directly corresponds with a reduction in the listings of identity takeovers, which saw a significant drop of 16.6. Market research implies two changes here. While investment in biometrics and identity verification has suppressed some ID theft, there is still an underlying strong presence of ID takeovers where fraudsters rapidly adapt and turn to organizations and sectors which have not adopted such strong protection measures. ID takeover does make up the proportion of listed fraud activity on the database. Some of our ID takeover activity have been investigated and reported as money mules and money laundering activity through better detection methods and new technologies available in market to determine that an ID takeover is actually the result of money muling activity. If we move on to the next slide, we can look at another type of fraud. This is where we've also seen a large shift in the listings. Trends over the past year for first-party fraud, that is, where applicants falsify or submit conflicts with their own data, is driving significant growth in the credit listing space. First-party fraud combines conflicting information with document fraud. These are two subsets, and I'll just quickly define those for you. Conflicting information is where a real person has falsified one or more elements of the application, including identity, which had a material impact on the credit decision made, such as providing false information about their employment, residency, visa status, or omitting existing or ongoing financial commitments. Document fraud is where a real person has falsified one or more elements of the document supporting the application. This could be also with their identity. Here we have examples of fabrication or counterfeit documentation like bank statements, driving license passports, falsifying or changing their name, applicants who have falsified or one or more of their identity details within their ID document, such as a single name, date of birth, driver's license number, and address or employment details. Now, in this area, we've seen 25.5% increase in applicants manipulating application information, and within credit products specifically, a 14.3% growth in fraudulent first-party document fraud. Research and articles from public bodies indicate that this is fueled by several factors. The accessibility to low-cost AI tools that allow consumers to create sophisticated fake documents and personas. The rise of social engineering, where online communities share how-to guides to bypass system checks. And tragically, also economic pressures. This pushes also financial stress onto an individual who may be in other circumstances then more susceptible to manipulating an application for credit that they cannot afford. We'll move on to the next slide and then talk also about how some of the falsified documents trends are shared. Now, while money mules still dominate in terms of volume, when it comes to securing large amounts of money, high value credit products, document fraud remains really the vector of choice. We can see 98.5% of all false document fraud is aimed directly at credit products, which makes sense as we have more complex and document intensive processes to access credit products over non-credit products, such as bank accounts or telecommunication accounts. This is where the largest financial loss exposure is also reported. And we're seeing it is being targeted by malicious actors in the 11.1% increase in related fraudulent credit listings. To reiterate, false document fraud is not about stealing a real person's ID. It's about creating a believable lie, falsifying elements like images, or modifying genuine documents to support a fraudulent application. It is a calculated act of deception to get past those defenses you already have in place. A new development is the re-emergence of synthetic and fabricated identity fraud. Although in the past we have had a lower reported volume, and it is still a small proportion of all fraud reported, this area has seen a large spike, so almost 100% increase. This rise clearly signals that fraudsters are now powered by advancements in technology, specifically AI, which is allowing them to create synthetic profiles that are increasingly difficult to detect. The key factor driving this are really technology available, high velocity attacks, and the quality and low cost of these new forgery tools to enable a new wave and a new demographic of fraudsters. So moving on to the final slide, I will then align this to some of the terminologies that we have up there. And for those of you not so familiar with fraud, I would really recommend the Commonwealth's Fraud Prevention Centre's fraud personas as a great source to have an insight into the actors that may be attacking your business. We see 3 distinct risk profiles that suggest a single layer of defense is not enough. First, we have the fabricator. These are everyday consumers using fake documents to bridge affordability gaps. This is a direct growing credit fraud risk. Secondly, we have coercers. Vulnerable money mules are being exploited by organized crime, a massive compliance risk also for your organization, enabling global money laundering. And finally, there's a deceiver. One of the greatest threats of the modern age, AI and deepfakes are used to build synthetic identities for long-term bust-out frauds. To protect our institutions, we must pivot a robust verification for fabricators, behavioral monitoring for coercers, and advanced technology to unmask deceivers in a layered approach that shared fraud database forms a part of. Alongside working closer together across industry and fraud prevention data sources, we really see this is the way forward for industry to react to the trends that we're displaying today. So in summary, there's a few things for us to watch out for. Fraud listings do continue to grow and are expected also to rise throughout the next year, and specific in the credit product areas. Document fraud is driving a surge in the type of first-party fraud being committed. Money mules continue to be a significant concern, growing at a rapid rate, targeting non-credit or transaction accounts, and are also sometimes being used to springboard into high-value credit accounts once a profile is established. So there you have it. It's a sneak peek into our Frauds Insight report that I mentioned at the top of this section of the presentation. So I would welcome you to download that report once available, and our marketing teams will be following up with the link for that. So I'll pass back to Carrie and she'll wrap the session for us. Yeah, just on mute.
Oh, yes, there needs to be an unmute notification in every webinar. Might ask you to stay for a little bit, Chris, for a quick question. So there's, I've got a member of the audience wanting to know a little bit more about first-party fraud, the fact that it's increasing so significantly, especially that it's so difficult to prove. Can you talk to us a little bit about the definition that we generally use when it comes to first-party fraud?
Yeah, exactly. So I think I saw that question pop in before I went into my definitions.
Yes.
But we do define 2 areas. So with first-party fraud, if there is a conflict of information present in the application that results in the suspicion and investigation and determination of fraud, this can be then added as a record. We also have then document fraud. So that is where there has been a determination that a document has been manipulated, either through a technology tool or physically through the individual and used in the application. So for instance, they might use a manipulated driver license or a passport and run a DVS check, and then the numbers do not align, or it's also proved that the image has been pasted over in the past. This is becoming increasingly more difficult to prove with AI technology. So it's really a layered approach we're looking at to combat this.
And I think there's another question that's going further into that. What can be the mitigants to reduce ID frauds and first-party frauds?
Yeah, so it's really, as again, looking at a layered approach here, something that we can also provide through one of our hubs that we call ID Matrix across the whole of the identity and fraud digital solutions portfolio. So I just mentioned recently that you have things like standard checks against your government databases with Vivo checks, DDS checks. Then you have the checks when you're sort of combating new technologies with biometrics, behavioral biometrics, device intelligence that you can apply that actually analyze that the person who's making this application is who they say they are. And then finally, the layer and the differentiation that Equifax provides, and this drives quite a few of these insights here, is that collaboration across industry to prevent fraud with shared data and intelligence.
So yeah, I think there's a myriad of different ways of doing it. It really comes down to, what are the individual use cases and how the immediate questions that the clients are looking to face. So it's probably something that we can, talk to individuals who are interested to take this further. On that one, I've got a question on when a fraud event is detected by one lender, how quickly is that event reflected and how does it work through the system?
Yeah, so there's two aspects to that listing. First off, once an alert is received by one of our members, they do need to investigate. After that investigation process, then they have, as part of our selected rules of engagement, are to list that within a certain SLA time. And then once that has entered our system, it is available in near real time for any additional applications that would flow through.
That's really important in the fast-moving world that we are all in. That the faster the fraudsters move quickly, and so do we have to move quicker than what's happening out there.
Exactly. We do see syndications moving around. They'll find a new attack vector. They'll know where potentially an organization hasn't implemented a certain solution in their fraud defenses, and they will try that across the ecosystem.
Timing is quite critical. I can see there's a lot of interest in this space. So just for information, like a recording of today's session will be made available to the audience. So if you want to share that with other people, that's available. But if you do want more information on if we want to be more in touch about how we can help, please leave a message in the survey that we'll present shortly so that we can get in touch for those conversations. Does fraud get reported in Equifax and impact the scores, Mr. Fung?
No, so this is a separated solution. So fraud is, there's no crossover into consumer retail risk, credit risk.
Right.
In scoring.
Okay. Oh, Stuart, a couple of questions for you if I can. So what are the changes we're likely to see? Because APRA has put in some changes to the debt to income cap as of the 1st of February. Have there been changes, and are there impacts in the market that you can see?
So good question, Carrie. So APRA has introduced or tightened the caps around the proportion of loans that can be written at high debt to income ratios in the mortgage space. Is this going to have a significant impact? Probably not. We've seen high debt to income ratio loans sitting at less than 10% of those loans being written in market up until now. So the new cap that they've brought in of 20%, all of the lenders are well within that at the moment, though they may become a little more cautious about lending at high debt to income ratios going forward.
Thank you. So the rates have gone up. How has the market reacted so far in 2026? And do we think, how is it going to trend?
I think it's a little bit early to see anything in the numbers today because it's only been a few weeks since the announcement. So,
That's right.
but as I was saying before, where we did see some very significant increases in both inflation and interest rates going back a couple of years ago, that drove a decrease in consumer credit demand. It drove an increase in both arrears and hardship. In this cycle, certainly in terms of the forecasts that we're seeing from economists today, that is likely to be a much more moderate impact in this cycle. And so we would expect to see a much more moderate impact to credit demand, arrears, and hardship as a result.
Yeah, definitely. I think last time we had rate increases, the speed of it, the velocity of it was quite different, and it was quite steep very quickly. So I think that made a huge difference to how the market reacted. So it would be interesting to see, what it's going to be panning for the next few months. There's a question on the commercial webinar. Yes, there is a commercial webinar. Now, that's a good question. I don't know exactly when it is, but it is definitely there. So I'll take a note of this audience member and make sure that either you're included into the invitation for that, or if it's already happened, we'll send through a link of that webinar.
Best option is to contact your Equifax account manager.
Yep.
Within our CRM system, we can flag any of our contacts to be able to get the invitations for either the consumer or the commercial webinar. So your account manager should be able to facilitate that for you.
That's right. And and once you've registered for that, then you'll get any ongoing invitations for any webinars that we're going to happen in the future as well. So worth talking to your account manager about that. Excellent. So we're at time. Apologies for my dog in the background if you can hear that. Thank you, Stuart and Chris, for taking us through the consumer market and the latest fraud trends. Quick reminder that there will be a short survey at the end of the webinar, and we really appreciate any feedback from this session. And a recording will be sent through and made available to you today. Thank you very much. Have a good evening, afternoon first, and a great weekend coming up.
Thank you, everyone.
Thank you.
Thanks, all.